And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Today, of course, it's Thursday, second best day of the week. Lots of stuff to get into after yesterday's CPI number. As we said yesterday morning, that was going to be the market moving event yesterday for the most part. And what we had said then was that the way the market was set up, if the number was fairly hot, that, closer to 6%, then we would likely see a fairly sharp sell-off in the markets. If it was much weaker, in other words, if the beginning number of that CPI print had a 4 in it, we could have seen a much stronger rally in the markets, and we really got a nothing burger of a day, really, in terms of CPI. Yes, headline CPI did come in weaker than expected. It was up about 0.1%, but the core inflation, that's the number that really the Fed looks at a little bit more, was still up 0.4%. And if you take a look at both core and what we call sticky CPI, those have really not come down that much. And so again, the market yesterday kind of flopped around. Most of the day did sell off into the afternoon a bit, because the reality is that the data does not suggest right now that the Fed is going to pause, much less pivot and start cutting rates anytime soon. And remember, the markets are already pricing in 110 basis points of rate cuts by the end of this year, and there's really no evidence at this moment that the Federal Reserve is going to be anywhere close to cutting rates soon, unless the economy slips into a recession. And with employment strong right now, with inflation, the sticky kind of core inflation remaining fairly high, the odds are that the Fed is going to be hiking rates at the next meeting and potentially saying they're going to have to hike more. Now, that was also in the FOMC minutes, so they released yesterday afternoon the minutes from the last FOMC meeting. In that statement, two things in particular came out. One was that the Fed was ready to hike 50 basis points at the last meeting had it not been for the banking crisis. That was the Silicon Valley Bank and others that were kind of on the ropes right prior to that meeting. Had it not been for that, they would have hiked interest rates by 50 basis points. The second thing is they do see a mild recession. Now, be careful with that statement, because the Fed never says they expect to see a recession. They've always said in the past, oh yeah, growth is fine, subprime is contained, it's a Goldilocks economy. They never say the economy is going to be in a recession, because if they did, everybody would panic and immediately we'd be in a recession. Well, now for the last several months, the Fed has been making repeated hints at, yeah, we could see a mild recession, but we have tools to manage this, right? So don't worry about it. If the economy slows down a bit, we got you, right? Mild recession. Well, if they've never actually said there was going to be a recession before, and we've had some and been fairly nasty, just how bad is this recession going to be when they're saying it's going to be a mild recession? Because if they said, look, we've really screwed the pooch here because we've been hiking rates and now all this is about to come back in lag effect, we're going to have a pretty bad recession. Immediately, everybody would panic. Market would be down 3,000 points and everybody would be out there just, stopping doing everything. And you'd have a really, really deep recession, right? And so the Fed can't come out and say how bad the recession will be or will not be, right? I'm not saying it's going to be a terrible recession. I'm just saying that the Fed has to really couch their speech well. And the fact is that we have never in the past seen the Federal Reserve say there's a recession coming. We've never seen that before. It's always been, hey, it's a Goldilocks economy, everything's fine. So anyway, we've got a lot of stuff to get into this morning with Michael Leibowitz to go over this. We'll talk about the impact on this, what the outlook is. One other thing, yesterday we talked a little bit about psychology in the markets, and Tuesday's article was that bullishness is still not extreme in the markets right now. Lots of bearishness still. That's kind of a good thing. That kind of gives the market room to rally. When nobody's buying into the rally, that gives the market room to work. I know that kind of seems counterintuitive, but that's the way markets work. But one of the things that we noted yesterday was this whole idea that, investors and psychology and the bad things that we do over time and then how this works out. And one of the things that we did touch on was this idea of buy and hold investing and why that doesn't work over time. And I thought this was interesting. There was an article out this morning talking about the NASDAQ. And the NASDAQ is now back to where it was 2 years ago. And we can actually see that if you look at where the market is right today, and we closed yesterday right on the moving average, it's exactly where it was now 2 years ago. So we go back to 2 years to May of 2021, and the market has made no gains in the last 2 years. Now, that's actually a pretty good thing, thinking what we went through last year, right, and how bad things could be. And of course, remember that at the bottom of the market last year, everybody was saying, oh, FANG stocks are dead. Well, of course, those FANG stocks have now led by a large margin. 90% of the returns this year so far have come from the top 10 stocks in the NASDAQ. But again, here's the point about this that I wanted to make, and this is the fallacy with this whole idea of buy and hold investing and average rates of return over time. So again, assuming that you need 6% a year to meet your retirement goal, well, you needed 6% in 2021, you needed 6% in 2022. What you've got now is zero over the course of the last 2 years. So there's a 12% lag right now between you and your retirement goal that you now need to make up. So in year 3 over here, not only are we going to have to make another 6% to get back towards our goal of 6% a year, we've also got to make up the 12% that we're still behind. And that's the problem with buy and hold investing over time, is that it discounts when you start running your math going, oh, well, if I just get 6% a year or 4% a year or whatever it is to reach my retirement goal, you have to adjust and account for years that you do not get those returns, because those have to be made up down the road. And this is why there's always such a massive difference between what people think they're going to have at some point in the future and what they wind up actually having, because they wind up taking too much risk in the markets, and that winds up impairing their returns because of losses. And again, we can go back and look at last year as a good example. In 2021, we had this massive surge in meme stocks and retail trading, etc. And we warned you then, we said this is going to end very badly. Of course, that has completely collapsed in 2022 and 2023, and a lot of those stocks are down a tremendous amount. In fact, over the last 2 years, there's about a 280 basis point lag between the markets and what meme stocks have been doing. So all that kind of fervor and froth that was in the market has now come out for most of that degree, but you have devastated a lot of financial investing over that time frame. I'm getting a lot of emails from people, hey, I'm down 70% in my portfolio, what do I do? Well, stop doing stupid things is the first good start, because that's the way investing works over time. If you treat the market like a casino, it will treat you like a casino, and it will take all your money. So invest carefully, invest wisely, invest conservatively. That will also get you better returns over time. But this is a very important part of the math calculation. So when you hear people say, hey, markets generate 8% a year. No, they don't. Markets do not compound. We touched on this yesterday, and this is a really good example, real time, with the NASDAQ. You're 12% behind your goal going into this year right now because of no returns over the last 2 years. You've now got to make that up plus 6% each year going forward. It's not as easy as that sounds, and that's why a lot of people really don't reach their financial goals on time. So just a little quick side note. I thought it was interesting on that note this morning. Outside of that, get by the website. Michael's article is out. We're going to talk a little bit today about de-dollarization. We touched on it earlier. Lots of headlines right now talking about this whole issue. And Peter Schiff out, of course, yesterday with another comment on the dollar loss and all this. We'll talk a little bit about that. Also more about the Fed, inflation, what that means for the upcoming meeting. Most importantly, what does it mean for the markets? That's coming up on the Real Investment Show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What's new with Social Security this year? Our next Lunch and Learn will reveal 7 things to watch in 2023. Thursday, April 13th at noon, Richard Rosso and Danny Ratliff will share Social Security claiming strategies, the 2023 COLA, and earnings tests. Our What's New with Social Security this year Lunch and Learn with Ratliff and Rosso, April 13th. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN, or again, simply online at realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
And welcome back to the show this morning. So yesterday, of course, was the much anticipated CPI report. Of course, as I said, really pretty much a nothing burger more than anything else. But there were some interesting data points in there. Also, one in particular, and we've talked about this before, that will probably suggest a very steep decline in inflation in the months ahead. But before we get into that, let's get in with Michael Leibowitz. Good morning. Welcome to the show. How are you, Mike?
I'm doing great. My allergies are killing me, but I'm doing great.
That's good. So what was your initial kind of takeaway from yesterday's CPI report and the market reaction?
I called ham on rye over a nothing burger. Boring. I mean, look, the problem is inflation is coming down. We see it. But, the headline is inflation fell from 6 to 5%. And on a year over year basis, that's true. But the Fed doesn't really look at that. That's a headline type number, because the problem with that number is it's looking at the last 12 months and saying, well, prices are only rising 5% a year now versus 6% a year ago. Well, inflation was rising 1% a month a year ago. Mm-hmm. So when you strip out that very high inflation and you replace it with much more moderate inflation, you're going to have mathematically big changes in the year over year type calculations. Yeah. But if you look at quarterly, what it's done for the last 3 months, if you look at core, like Lance mentioned earlier, the inflation rate is sticky. It's slowly coming down. It's still 5%, even if you want to use the year over year metrics. The quarterly metrics point to it being about 4%, which is better than 5%, but it's been running at 4% now for 7 months. So the Fed really thinks they have a problem on their hand. Nothing a good old recession can't help, but they have a problem on their hand. And I think they're kind of telling us nothing a good old recession can't help. They also, in their FOMC minutes, they mentioned that sticky core prices are very sticky if you exclude housing. Right. I mean, housing is also still going up, but core prices, and that's what they look at the most, they exclude food and energy because they tend to be very volatile, are sticky, and they're not really coming down. The other issue is that the last leg of this disinflation has been goods prices coming down and services prices still rising, but not as fast. Well, now we're starting to see service prices coming down, which is a good thing, except goods prices are starting to rise in certain sectors. And they're going to offset if this trend continues. And keep in mind, crude oil is now 83 a barrel. And at least here in the DC area, we're paying, upwards of, if you can find gas in the upper threes now, you're doing pretty well. So we're back to nearly $4 a gallon in gasoline. That is going to offset to some degree what should be a decline in services prices. But like the Fed's telling us, and they never tell us this, soft landing is about as bearish as they get. They're telling us to expect a mild recession. If again, let's talk about math. Right now, Atlanta Fed GDP is expecting 2% or so GDP growth. And that's more or less in line with expectations around Wall Street. So if the economy grows at 2%, what do you need for, you have 3 more quarters. What do you need for those 3 quarters to get to a negative at, some point? And the answer is that you need, like a minus 0.6, minus 0.7 for 3 quarters, or a minus 2% for 1 quarter. Any kind of gyration you can do here, but the Fed's telling you that number will come down and we will have a couple quarters at least of negative growth.
Right. Now, and again, this is their expectations as well, just looking at their data. And I thought there was a couple of interesting components. Talking about housing. Housing makes up about 40, and technically in CPI, we say housing. It's actually what's called homeowners equivalent rent. And there's a bunch of mathematical manipulations that go on inside this calculation to come up with it. That number actually, the housing component actually dropped fairly sharply in the last quarter. But this is something you and I have talked about before, is that the decline in housing runs a very big lag to the index. And, you take a look at Schiller's, home price data, it's 3 months in arrears. So, that whole, kind of lag effect of rising housing prices that have now become falling housing prices is now starting to show up in the headline, kind of CPI number. And so that's going to be one thing that really suppresses, and back to your other point as well, talking about math, when you say CPI is rising at 5% on a year-over-year basis, it's rising at 5% on a year-over-year basis. If prices don't move between today and next year and everything remained flat, inflation would be 0.
Right.
But we'd still be paying a whole lot more for everything, right? So, that's the fun with math part. But this housing component can certainly drop that big headline number, which, to your point, that's why the Fed really doesn't pay as much attention to the headline and pays more attention to that core, which is what consumers deal with on a regular basis. And this is an important point because we've discussed this before. Mike, inflation has been up over the last, couple of years, 7, 8, 9%. Has your house payment changed? And the answer is no, right? My mortgage payment doesn't change. My rent payment doesn't change because they're contractual agreements. And so when you look at the inflation data, you've got to kind of back out some of the logic of this and saying what really impacts the consumer. It's not housing, it's not rent, unless you're going out and buying a house today, or if you're going out and signing a rental contract today. That's going to make a difference because, yes, you're going to pay more for that today. But if you're already in these contractual obligations, same thing for healthcare. Your healthcare doesn't change in price for an entire year until you have to re-sign up at the next open enrollment period. So the Fed looks at this core because that's what consumers are dealing with on an everyday basis. And that's why the core and the sticky core is much more important. And the sticky core excludes housing altogether. So that's why they look at these data points more importantly. And Mike, to your point, that's what they're looking at when they're making these policy rate decisions. And those sticky core numbers aren't coming down near enough to suggest the Fed's going to start cutting rates here.
Right. Right. And here's the dirty little secret. And it's not a secret because the Fed told us this. They know that if inflation, or that if GDP continues to run at 2%-ish, inflation's not coming down.
Right.
It's going to remain sticky right around where it is. It could even go up a little bit. They know they have to administer a recession. They need higher unemployment. They need GDP to come down. They need consumers to stop spending money as much as they are today. And you can make whatever kind of political judgments you want on that statement that they're basically wanting a recession, but that's how you are going to get inflation down. And then the argument is it worth a few jobs to get inflation down? Are you penalizing some to help the majority of others? And that's a debate we can have all day. but the Fed is charged with having stable prices and maximizing employment. Employment is beyond maximized right now, according to some measures. Some people argue there's still a little slack in the system, but nonetheless, the employment market is really healthy. And I feel like they can give up some on that side of the ledger, let the unemployment rate tick up to, it's at 50-year lows. Let it tick up a little bit if it'll bring prices down. And that's the juggling act they're going to try to conduct over the next 9 months.
So yeah, and this is going to be the challenge, right? And this is when we come back to looking at the financial markets. The markets are betting heavily and have been betting heavily ever really since the October lows that the Fed's going to pivot, the Fed's going to cut rates. Right now, expectations, Fed funds futures expect right now a 25 basis point hike at the next FOMC meeting. That's pretty much baked into the cake right now after yesterday's CPI report. That'll bring the Fed funds rate up to 5%. And the Fed is likely going to, and we've said this before, and again, it's interesting to me that the market hasn't figured this out yet, is that the Fed's going to hold that rate at 5% unless there is a recession. Or unless there is some other type of, and the Fed even mentioned this, and Warren Buffett talked about this yesterday as well when he was being interviewed, that the banking crisis situation isn't behind us. There's likely going to be some more bank failures coming. But that's the only environment where the Fed's going to be cutting rates. X those events, there's no reason for the Fed to cut rates. I mean, that would actually be nirvana for the Fed. What a great position for the Fed to be in. I can put interest rates at 5%. I can reduce the balance sheet back to, 300 million or 300 billion where I started in 2009 and, put everything back to where it was monetarily if everything is fine in the markets and the economy. And now I've got all this ammo for the next recession or crisis whenever it occurs. So this idea that the Fed's going to be cutting X some type of event seems a little bit naive by the markets.
I think that's the soft landing the Fed was talking about that they thought they could pull off. Now they kind of realize they can't.
Mm-hmm. Yeah, I agree. So we'll see what happens. I think it'll be interesting. But when we come back from the break, I want to shift gears a little bit. We'll talk a touch on your article yesterday that you had posted talking about the dollar. We've just been getting a ton of questions and concerns from both clients and prospects about this idea of de-dollarization. And, the whole world's going to hell in a handbasket. Can't really disagree if you just take a look at the media. But we'll talk about de-dollarization. Peter Schiff out yesterday making some comments in this regard. So I'll kind of play a little bit of counterpoint with Mike after the break on this idea of de-dollarization. And is it really as big of a threat as everybody makes it out to be? And B, should you be making portfolio changes to adjust for this? We'll be right back after the break. I'm Harold Lance Roberts. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
What's new with Social Security this year? Our next Lunch and Learn will reveal 7 things to watch in 2023. Thursday, April 13th at noon. Richard Rosso and Danny Ratliff will share Social Security claiming strategies, the 2023 COLA, and earnings tests. Our What's New with Social Security this year Lunch and Learn with Ratliff and Rosso, April 13th. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
You're listening to The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
So last night I wasn't sleeping well, so I got up and went into the living room, just kind of laid down on the couch for a little bit. And she always leaves a light on in the front of the house.
The Real Investment Show podcast. Same show, your schedule.
This morning my wife is up. She's like, honey, did you know that the lamp was off in the living room? Why is it off? Did somebody break in last night? I said, yes, honey, a climate activist broke in last night, turned our lamp off.
At realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
Real Investment Show podcasts are now available from Stitcher Smart Radio at Stitcher.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA Advisors to work for you managing your 401k plan. It's a quick and easy application. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access. Now with the new and improved Before the Bell Report, Candid Coffee, and Lunch and Learn replays, plus each day's radio show. Subscribe and bookmark our YouTube channel or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
Welcome back to the show this morning. So, shifting gears here just a bit, I've actually got a couple of linked topics relating to the dollar and de-dollarization. And it was interesting. There's been lots of conversations lately, lots of podcasts, talking about de-dollarization and that the world is going to move away from the U.S. dollar as a reserve currency. Let me just give you a quote yesterday from Peter Schiff. We may lose, and he's talking, this is specifically to the loss of the dollar as a reserve currency. We may lose that privilege, being the reserve currency, over the next several years, maybe even over the next few months. And this is, these kind of comments have certainly generated a lot of emails and questions and concerns by both our clients as well as prospects and just listeners to the show. People that visit our website email us like, what do you think about the dollar? We're going to lose the dollar. Don't we need to be all in gold? A couple of things. And this is crucially important. And Mike wrote a very good article about this yesterday as well. It's on our website now at realinvestmentadvice.com. Before we get to the discussion of de-dollarization and the loss of, reserve currency, let's talk about gold for just a second as well, because this all goes into this. The idea of owning gold as an alternative for a fiat currency is not valid. And the reason is that because no currency on the planet is backed by gold anymore. Every currency in the world is a fiat currency. Every currency is backed by a money printer at the central bank of that country. So If Russia wants to print more rubles, they print more rubles. If we want to print more dollars, we print more dollars. That's the benefit and value of having a central bank and having a printer or a treasury department and being on a fiat currency. You can always print more money. This is one of the things that gives the full faith and credit of people buying treasuries the ability to get paid back. Despite all the other, comments and concerns about debt ceilings and everything else, the debt will always be paid because we can print the money to do it. Now, that's not a good thing, right? I'm not saying it's a good thing we can print money. We just have the ability to do it. The one problem for the euro is that the French and the English and the Spanish and the Swiss all gave up their ability. I shouldn't say, that's incorrect. I said English. That is not true. UK is not part of the euro. But they gave up their ability to print their own currency. They're all in the euro system, so they're dependent on the European Central Bank. UK can still print the pound. But the point is everybody can print currency, and that has a issue of itself and causes problems. But if you own gold, that's great, but we're not on a barter system. So try to take your gold bar, go down to Starbucks and try to buy something with it. You can't, because they can't convert it into dollars. The only way you can spend your gold is to go convert it back into that fiat currency that you are trying to get away from. That's the way the world works now. And this is one of the issues we'll talk about in a minute about central bank digital currencies as well, where we're trying to get to is a further diversification away from a chunk of metal, right? So it's important to understand these. I'm not saying don't own gold. That's entirely up to you. It's a commodity. It's got a value. You can buy it. You can sell it. You can do those type of things in the open markets. It's just not a replacement for a currency because we're not on a barter system. If we are on a barter system, we got bigger problems. We got a lot bigger problems, and you better have some lead to go along with your gold. But that's a whole different conversation. So here's the problem. And, so let's talk about de-dollarization. The idea is that we're going to wake up one morning and the rest of the world is no longer going to be trading in U.S. dollars. And that's going to be a catastrophe to the U.S. and it will be problematic if that would occur. But as we've talked about before here on the show, and I will now turn it over to Mike to let him explain to you why this is most likely not something that we need to worry about over the next few months, much less the longer term. Mike, your thoughts?
So yesterday I published part one of an article, and what ended up happening was I was writing, and this thing ended up being a monster. So I split it in half, part one this week, part two next week. Part one just lays the groundwork. What is a reserve currency? Why is it the dollar? How did it switch from the pound to the dollar, and why? And that helps you appreciate why the dollar is the reserve currency and how it's become so important and why it is still very important for global trade. Now, everyone agrees to some degree that there are big problems with the dollar. We, the United States, are grossly mismanaging our financial system. Way too much debt, not enough productivity, poor economic growth, considering how much debt there is. We're just becoming more over leveraged by the day. And yes, in time, we will either inflate our way out of it or bankrupt in time, not today, not tomorrow. So the question I think you should ask is not whether the dollar is good or bad, whether it should be the reserve currency, but what's the replacement? When you think about that question, okay, well, if the world is not going to use dollars, what can they use? What can offer the same thing as the dollar? And that's when you can come, if you really go through that, that's where you come to the conclusion that there really is no answer. And part two of my article coming next week talks about why the dollar is preferred. You have the rule of law. You may not think our judicial system is perfect, but it's a hell of a lot more perfect than China or Russia. And it's on par or better than most other nations that have a currency that could potentially compete. Far and away have military might. You think Ukraine's going to go off the dollar anytime soon? If they made an announcement yesterday, they're going to start using the euro or some other, or Bitcoin or gold, they're going to lose to Russia in 2 weeks because we're going to pull back all our support. We also have the world's largest economy. So by default, so much trade just goes through this country, and it's much easier to accomplish if it's in dollars. So there's a lot of reasons why it's the dollar. And you start thinking about, well, what about, let's say, gold? There's a couple problems with gold. A, like Lance said, if we went to just gold, you're bartering and you're walking around and chipping off slices of a gold bar to buy a cup of coffee. That doesn't work. But I think what some people would, probably Peter Schiff would like to see, is a gold-backed dollar. And we used to have that. The problem with the gold-backed dollar is the amount of dollars is limited to the amount of gold. And gold production only changes by a couple percent. It only grows by a couple percent a year. So you are limited in your money supply growth to a couple percent a year. And again, we can debate whether a limit on money supply growth is good or bad. But I can tell you right now, the Fed and the government will not go for that.
Well, and one thing is that you think you have bad inflation now. Wait until you have, money limited by gold. You're going to be talking about paying tens of thousands of percents of inflation from where you are today.
Right. So then there's Bitcoin. Similar problem with Bitcoin. Do you really think the U.S. government or any other government is going to relinquish their control over the currency? Because once they do that, they relinquish control over the economy and the country. So gold and Bitcoin, or gold-backed dollars and Bitcoin, are not very probable. Then you start going around the horn. Ain't going to be Russia. Is it China? China doesn't have the rule of law. They're a communist country. They'll take the money. They don't have liquid markets. Again, I failed to mention that. Liquid markets are very important because the world, every nation has reserves of, it's like their bank account of dollars that they use to buy and sell in foreign markets. Well, where are you going to keep, if I told you have to hold on to $1 million worth of Yuan and you have to put it in a Chinese bank, how comfortable are you going to be with that? And where can you invest that money? And will you be comfortable investing it in a safe place to know you get it back when you need it? So China is not the answer. Saudi Arabia is certainly not the answer. Euro, it certainly has taken, it's about 20% of the world's trade goes through the euro, but they don't have liquid markets. They don't have military might. Their economy is really not that big. Germany is a $4 trillion GDP versus our $24 trillion. Yeah. And Germany's the biggest nation in Europe. So you kind of go around and you look at all the other potential global reserve currencies. And yeah, the dollar's not perfect. It's far, far from perfect, but there's no replacement in sight right now. Yeah, not that can't change, but right now there's nothing.
Right, and and the big thing is, and the one, and you touched on this point, but I think it's the important point to reiterate here, which is, think about all the dollars of trade that occur every day, buying and selling of goods and services. We import a tremendous amount of goods into our country. We export a tremendous amount of goods from our country. All those transactions, you need a currency that is deep and liquid enough to handle those transactions. So when you go back and talk about some of these countries, sure, maybe we could do it in the Chinese yuan or the Russian ruble or the Japanese yen, maybe, right? The question becomes, are those currencies liquid enough and deep enough to handle those transactions without causing a massive surge of inflation because of a lack of supply of the dollars or the currency to handle those transactions? But there's one other point on this, and then I want to switch over to central bank digital currencies because it tags into this very specific situation. But when we come back from the break, we'll touch on some of the concerns about the recent moves away from the dollar and what that actually means. Don't go away.
Get Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What's new with Social Security this year? Our next Lunch and Learn will reveal 7 things to watch in 2023. Thursday, April 13th at noon. Richard Rosso and Danny Ratliff will share Social Security claiming strategies, the 2023 COLA, and earnings tests. Our What's New with Social Security this year Lunch and Learn with Ratliff and Rosso, April 13th. Register now at realinvestmentadvice.com. realinvestmentadvice.com.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets. And unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Get started right now at the website, realinvestmentadvice.com, or simply call our toll-free number, 855-RIA-PLAN at realinvestmentadvice.com.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
The Real Investment Show.
So, I wanted to wrap up this conversation on de-dollarization real quick and then talk a little bit about central bank digital currencies because Florida has made a very interesting move in that direction. But real quick, one of the issues of late has been some of the headlines. China cut a deal with Brazil to transact goods and business with Brazil using the Yuan. We've seen other moves where headlines where some deal was done to sell oil in some other currency or whatever it is. Well, these are a very small percentage of transactions. Over the last 20 years, the use of the dollar as a reserve currency was about 73%. It's gone to 59% over the last 20 years. There's a lot of reasons for that. But importantly, one of the things that if you're constantly putting tariffs on my country, if you're constantly attacking me, politically or, economically, et cetera, I'm probably going to try to figure out how to do some transactions to bypass the dollar because you're putting tariffs and restrictions on me, right? In the case of China. Or there's another factor here, which is the cost to the economy. So if the dollar is strong relative to my currency, right, and I want to buy things in the dollar, it makes things more expensive for me. So not only do I have the inflation of price just because of general economic situations, but now if I'm trading in dollars and I'm using a weaker currency, it's adding to that inflation rate on top of that because of the currency exchange. So in that environment, I will probably try to figure out how to do a transaction in another currency to offset that potential currency exchange variable that's adding to the price of the goods or service that I'm trying to do. So the point about that is that, yes, we're seeing some headlines now where certain things are going on because of either we're politically, geopolitically, economically, et cetera, attacking a country, or because of the relative value of the dollar and inflation of goods and services on a trade basis. So when those things change, so will the use of the dollar. So in other words, if the Chinese yuan became much more expensive than the dollar, you would see people wanting to start to transact in the dollar. That will reverse. So again, be careful with it. All I'm saying is, just be careful when you read a headline that says A is transacting business with B in a different currency. That doesn't necessarily mean it's de-dollarization and they're making a permanent move away from the dollar. They're simply structuring a deal to bypass inflation or to bypass sanctions, et cetera, that are currently happening in the economy. Mike, your comments to wrap that up.
Look, China and Russia would love to get rid of the dollar. It ain't going to happen, though. And they're going to do one-off deals with countries that like them. And there really aren't that many countries that are willing to shun the dollar.
That's right.
So, unless it's these one-off things can happen because both countries require things that each one sells, but they're very difficult and they're costly and they economically don't make as much sense as the dollar. So yeah, the dollar will slowly lose its status, but that's slowly, and that's been going on for 30 or 40 or even more years. Yeah. This isn't anything new.
Right. And that was my point. Even at the peak of the dollar power as a reserve currency, we didn't have 100% of the market share. There's always transactions going on in other currencies, and that's been going on for 50 years.
Right. And it will. There's no such thing as one reserve currency that is 100% of all transactions. And actually, the dollars as reserves have been shrinking, Lance, but dollars as a percent of transactions has been very stable at a very high number. So it's countries are holding less dollars, but the transactions that occur in dollars are barely slipping.
Yeah. I want to shift gears here real quick because it does apply to de-dollarization. But it's also something I thought was interesting, central bank digital currencies. There's been a lot more talk from the Fed, Treasury, others about, there's a CBDC, central bank digital currency, in testing form right now. They expect to potentially have a CBDC out within the next couple of years that'll be, kind of handling this. And this is something that Mike and I were talking about 4 years ago relative to 4 or 5 years ago. Mike and I were talking about this relative to Bitcoin is that, Bitcoin is awesome. It's cool. It's neat. It's a thing. But ultimately, at the end of the day, and Mike mentioned this earlier, no government is going to allow a third-party currency to be involved long-term with the economy. Once it becomes a threat to trade and to economic stability in some form or fashion, it'll get replaced, deregulated, et cetera. And we're seeing that already now. And this is why central banks are now coming up with their own digital currency. Great. Bitcoin was a great test bed. They got to see it work. It's like, yeah, okay, people are interested in this. We can make this work. So now they're going to, print their own and create their own digital currency. This is also why you can't print money in your basement, because as Mike said earlier, the control of the currency is the single most vital thing in terms of economic stability and national security. If you lose control of your currency, you have no control over your economy. What a central bank digital currency will allow the central bank to do is to basically understand and know exactly where every dollar is at every moment within the economy. So it's, there's a lot of loss of privacy, obviously, that you can start talking about, but it does provide a very exacting control over the economic transactions within the country by understanding exactly where every dollar is. I thought it was interesting, Mike, from that standpoint. Florida, Ron DeSantis, just signed a bill that is outlawing any central bank digital currency in Florida. He's also been in touch with Lieutenant Governor Dan Patrick here in Texas about potentially doing a similar bill here in Texas. And their view was, and Ron DeSantis' view is that the value of the dollar is very important to economic stability, but it's also important to the privacy of the individual citizen. And so they're saying no to any central bank digital currency, that the dollar needs to be the dollar in your wallet that you have control over, and also your privacy. And I just want to get your thoughts on that.
Look, I think a lot of people are very scared of these digital currencies because it gives a lot more power to the Fed. They could, in theory, print without telling anyone. And look, every transaction will be monitored and scrutinized. But Lance, is that really any different than what we have now? I just pulled out my wallet and I took out about $100 in mid-March because I went away. And I'm looking at it now, and I have $7, $8, $7. That $7 has been in there for about 3 weeks.
Yep.
I have bought all kinds of things. All of it has been digitally purchased with my credit card. I've moved money from bank accounts. 95% of the transactions in my life are digital already. If you don't think the government's not looking at your credit card, your ATM, your bank accounts, they are. The only thing they're really not able to track are currency transactions. And really ask yourself, what percentage of your transactions happen in paper coin currency? For me, it's especially since COVID, I don't go to the ATM anymore. I'll go once every 6 months for, if I'm going on vacation, I want a few extra bucks, and that's about it.
Yeah.
Lance, are you any different? Do you use cash?
No, I the only reason I have cash, and so, I have cash in my wallet. I was just looking in my wallet, so I've got $31 in my wallet right now.
Rich guy. Rich guy.
I always carry cash. I always try to carry cash just in case of emergencies. But I figured this out, and I don't know how this happens, but my kids are psychic. So whenever I'll put like $100 bill in my wallet, just because, again, you break down on the side of the road, something like that. I feel I'm old, right? So I'm a boomer. I just feel like I have more security if I have a little bit of cash in my wallet, just in case. Need to pay somebody for a ride somewhere, whatever. But as soon as I have cash in my wallet, my kids invariably ask me for money. I don't know how they know I have cash in my wallet, but they have a direct link mentally to my wallet. So,
Lance, I have 3 kids, and I guarantee you, if I went through their wallets right now, I'd come up with $0.
Oh, I know.
They do not use cash at all. And that's the generation that is kind of taking over the economy and will.
Yeah, my kids, both my boys don't carry wallets at all. They basically,
actually, mine don't either.
Yeah,
you're right.
They have a little on their sleeve phone thing for their, that they have their license and a credit card in or debit card in. I mean, and that's it. That's all they pretty much carry with them, and they carry no cash.
And before COVID, I always thought it was ridiculous, these people that would buy like a $2 cup of coffee or something for $1.50 with their credit, debit card or credit card. That's me now. And the only time I will use the cash is because I want to get rid of it. It becomes, if I do have too much, it becomes too bulky in my pocket.
What is too much cash? A wad of $50 worth of ones? I mean,
the problem is it ends up being ones. You get stuck with all the ones.
Exactly. It's kind of like the old days where you threw your change in the jar.
Right.
And you had, and now I've got a jar of dollar bills that are just kind of a pain in the butt. Anyway, but no, I think it's very interesting. This is, the world is changing, and I think it's important that we recognize the world is changing. We need to understand why the world is changing. We need to understand where we're headed. And we are headed towards a digital currency, digital society. And that's clearly evident from just all the transactions that everybody does, you included, every single day. How much do you do electronically, online bill pay, etc. We're moving in that direction. But that doesn't mean, and this is the important thing to take away from all this, before you start making big investment decisions that can have life-changing effects on some outcome that you believe to be the case of, a major debt default or, de-dollarization or whatever it is, really think through those decisions, because they can have a major impact on the outcome of your money and your wealth. And that's why we're here to kind of talk you off the ledge a little bit, right? So take that. Do what you will with it. Get by the website. Michael's article is out, part 1 of that dollarization article on the website now, realinvestmentadvice.com. Our newsletter will be out this weekend as well. And make sure you subscribe to our channel right here and click that little bell icon for notifications. We appreciate you for watching. We'll be back tomorrow with Financial Fitness Friday. Have a great day.